Hello everyone, welcome to the video. Myself Lakshminarayana K. I am the faculty in the Department of Commerce, SDM College Ujire. Today in this video, I will be explaining you about one of the important concepts of income tax, that is TDS or tax deducted at source. This tax deducted at source is a very important concept in terms of collection of tax by the income tax department. Basically, it is a part of income tax only, and it has to be deducted by a person for certain payments which they make to the second person or to the other parties. So, normally what happens, the assessee upon receiving his income is supposed to make the payment of tax at the end of the year. If I earn the income in the previous year as per income tax rules, the income earned in the previous year is subject to tax in the assessment year. So, the due date for filing income tax returns will be always in the assessment year. For example, the income what I have earned in the year 2023-24 is subject to income tax in the assessment year 2024-25. So, by July 31st, 2025, I have to file my income tax returns and disclose the source of my income to the income tax department and make the payment of tax. So, this makes advantages for the assessee at the end of the year making the payment of tax in one way. On the other hand, if the government waits till the end of the assessment year or till the due date of filing the returns is over, there are chances, there are possibilities that the assessee may avoid the payment of tax. At the same time, the government will also requires funds or flow of funds throughout the year, and that may not be possible. So, to ensure the assessee does not indulge in any tax saving or tax avoidance or tax evasion methods, and government also gets regular flow of funds, the concept of TDS has been implemented. So, this makes what? The assessee in the year of earning income only will make the payment of tax, will not wait till the completion of due date for filing income tax returns or cannot wait for the assessment year. So, the source where he is getting the income, from that very source itself, tax will be collected by the person who gives the income to the assessee and it will be remitted to the government. So, this is a technique, a simple technique used by the income tax department to ensure the minimum collection of income tax. The concept of TDS was introduced with the aim to collect tax from the very source of income. As per this concept, a person who is liable to make payment of specified nature to any other person shall deduct tax at the source and remit the same into the account of the central government. This means, with example if I have to tell you, in the case of employment, employer will be called as deductor, employee will be called as deductee. The employer who makes a regular payment of salary to the employee every month will have to estimate the income of the employee by the end of the 12 months. Upon the estimation, if the income crosses the exemptable limit, then applicable rates of tax will be calculated, and on that calculation, whatever the amount of tax which will be supposed to be paid by the deductee or the employee to the government, that will be calculated, and that amount of tax will be collected in advance in the very source of disbursing the income. By doing so, the employer ensures a minimum amount of tax is collected before the income is handed over to the employee, and thereby that amount will be remitted to the government and government gets a minimum source of income or minimum guaranteed income to their treasury. So, this is the amount of tax that is deducted by the employer or a deductor from the taxpayer and which is deposited to the income tax department on his behalf or her behalf. So, what happens here? As per the income tax rules, assessee has to file the income tax returns and pay the taxes at the end of the year. So, the department will not wait till the completion of that period. At the very source of disbursing the income, the tax will be deducted. In the case of employment, it will be done by the employer. In the case of interest income, it will be done by the bank. In the case of professional fees, it will be done by the people who make the payment of fees to the professionals. So, like that, in other cases also, wherever the payment happens, the person who is supposed to make the payment will deduct the amount of tax and he will remit it to the government before giving the income to the person who is supposed to receive the income. Now, this concept of TDS, it helps in lowering the tax evasion also. So, as the assessees are supposed to pay the taxes at the end of the year, there are chances that in order to avoid the payment of tax, assessees may indulge in certain unwanted activities. They may try to leave the country, they may not disclose the entire source of income. There are different possibilities of by which the assessees will try to take up tax evasion activities. So, if we introduce TDS, so what happens when the income is dispersed, when the income is given to the assessee, while giving the income itself, tax will be withheld, tax will be taken back. So, the amount of tax, when we take it back from the assessee before giving the income to him or her, then that income is taken as tax and it is in the hands of the government now. And even later, if the assessee fails to make the payment of taxes, government need not bother, his share of tax is already collected from that assessee. So, the person who makes the payment deducts tax at the source, while the person who receives the payment or income has the liability to pay the tax. Again, as per income tax rules, if I receive the income, then I have the obligation of making the payment of tax to the government. So, if you wait till the end of the year for me to make the payment of tax, then I may involve in tax evasion methods. So, to avoid that, you will collect the tax or you will deduct the tax at the very source from where you are going to give the income to me for the efforts I have put in. So, this is about the TDS. Going forward, the meaning of TDS can be elaborated. TDS, or tax deducted at source, is income tax reduced from the money paid at the time of making specified payments such as rent, commission, professional fees, salary, interest, etc. These are the different occasions where the assessee will receive the income. In the case of rent, what happens? If I am the owner of the house property, then if you are the tenant in my house property, the rent whatever you have to pay is my income. Then the department expects me to make the payment of tax for the income I have received as rent. So, in order to ensure the government that they receive the income tax from me, they will ask the tenant to make the payment of rent by deducting the TDS. That means, the assessee will not make the full payment of rent to me at the end of every month. He will deduct a specified percentage of tax and he will remit it to the government, and only the balance of rent he will pay it to me. This is the case of rent. In the case of commission, professional fees, salary, interest, etc., in all these circumstances, that is what happens. Usually, the person receiving income is liable to pay income tax, but the government, with the help of TDS provisions, makes sure that income tax is deducted in advance from the payments being made by you. So, by deducting the tax in advance, it is helping the assessee, it is also helping the government in the form of ensuring the regular flow of funds. The remaining concepts of TDS I will explain in the next video. Thank you.